there. Welcome to Market Call. I'm Andrew Bell. For the next half hour, Lorne Steinberg, President and Portfolio Manager, is taking your calls. He's with Lorne Steinberg Wealth Management. Great to have you back on the show.
Andrew, it's fantastic to be here. Thank you very much.
Thank you very much. You don't like the look of the equity markets broadly right now?
Not at all. There's just way too much government debt, rising inflation, rising interest rates, and at the end of the day, rising interest rates are very bad for asset prices, bad for real estate. And the only people that are going to benefit from market decline is the one who has cash. And so we're holding about a two-thirds cash position in our equity portfolio.
Two-thirds. Well, we're going to get into that in more detail. Cash is your top pick right now. What about the international situation?
The international situation in Europe is a bit of a basket case, and that's just all, leading to all of this. And we're not predicting a depression or anything, but there'll be more pain to be paid before things right themselves.
What about gold? You mentioned government debt.
I never knew what to do with gold, but gold is trading, of course, at an all-time high. And there's so much speculation, so much hedge fund money chasing that's usually not the place you want to be.
Oil?
Again, tons of speculation, although there's no question. I mean, if the Libya problem gets worse, there are major oil fields in that part of the world, and, that would be a serious issue, which would increase the price of oil. But the biggest issue with oil prices is it's hurting consumers in the pocketbook. And higher energy prices means consumers have less money to spend elsewhere. And that's a negative for the economy.
It's a major tax on America, really. So much money flows out.
Absolutely. They don't get it, but they'll eventually raise taxes on gasoline, I expect. But it's really, really painful.
It's not going to be easy. Thanks very much. Well, okay, we're going to take a break. We've got Lorne Steinberg. He's taking your calls on value stocks and high-yield bonds. Call us toll-free, 1-855-326-6266, or an email to marketcall@bnn.ca. We will be right back.
'91 and is targeting annual production of 200,000 ounces of gold.
We have an email from Tom. The subject is BCE, which is in the process of buying CTV, including this network. Is BCE safe, or is it in your dangerous dividend class?
Andrew, BCE is in a very low-growth situation, but the fact of the matter is they've done a great job managing their costs. The dividend is safe. Will you see any dividend growth from here? I don't think you'll see very much. You're looking at kind of 3% top-line growth, 3% bottom-line growth. But they're covering their dividend. They're generating excess cash, buying back some shares, and I wouldn't worry about the dividend.
But it's not a dividend grower over the long term?
It's not going to be a big dividend grower.
Here's an email on Loblaws. It's from DJ. Would Lorne buy Loblaw at the current price?
I would not buy Loblaw at the current price, but let me say that this company has done a fantastic job at restructuring itself, coming off the bottom, huge improvement in their IT system, supply chain. They've done a great job on all those things. The biggest problem that they face is Walmart. Walmart is, you may know, the largest food retailer in the U.S. They are building out their footprint in a huge way in Canada. And they're pressuring the entire industry, and they're going to keep margins down on Loblaw and everyone else for a long time to come. But Loblaw is a well-managed business. They'll still be around. But no, it's for us just a little too expensive here.
It's 38 and change right now. What price would you get interested?
We'd get interested at about $30.
$30, so it needs to take quite the haircut.
Absolutely.
Here's an email from Al. The subject, real return bonds. Do you think now is a good time for retired investors to start adding some real return bonds to their portfolio? If yes, what % would he recommend?
First of all, real return bonds are inflation-adjusted bonds. So they're a perfect hedge against inflation. They're issued by the Government of Canada, so there's absolutely no credit risk whatsoever. The issue is they, too, have had a big run like so many other things, but they are yielding about 1 percentage point above inflation. So if an investor has a non-taxable account like an RSP or a RIF, certainly if you're looking for safety, they're a pretty good place to be, but they're not a trading security. I'd buy them and just put them away, knowing I'll beat inflation for as long as I own them.
Because, of course, if real inflation comes back, regular bonds will get destroyed, probably.
Absolutely. These will move inversely with the regular bond market. And so they are a perfect hedge against rising inflation.
Let's head to Lethbridge, Alberta. We've got Richard on the line. Go ahead.
Good morning, gentlemen. Thank
Morning.
you for taking my call.
Not at all.
I'm trying to understand the difference between a value stock versus a growth stock. And I have another question. What is meant by an enterprise space? And the difference between value stock and growth stock, I also want to look at RIM.
Okay, whoa, you got a threefold.
That's a lot, but I sure would appreciate your answer, and I sure value your guys' opinion. Thank you.
Thanks very much.
Thank you very much for the question. Well, first of all, value and growth investors are kind of two opposite religions, and we're deep value investors. We're looking to buy $1 for 50 cents. Growth investors are looking to buy companies where they think they can predict the growth level, and companies where they think that they can predict that growth will continue to accelerate above and beyond a certain point for a long period of time. RIM is a great example of that. RIM is a company that we've never owned because for us...
Never?
We've never owned it. They've always been, for us, expensive, even though they prove themselves. One of those companies, they deserve their premium multiple.
Because the multiple is pretty low in terms of PE right now.
Now it is.
Yeah.
And so RIM for us has gone from being a growth stock to possibly a value stock. We look for great companies that are really sound financially, but whose share price is beaten up. And we have to make the judgment call, is this temporary or is it something permanent? So suddenly RIM is like a 10 times earnings company. It used to be a 50 times earnings company. And there's a lot less risk for us buying value because you're paying a lot less for something. And you don't need a lot for it to go right, for it to work out. So we're looking at RIM at the present time.
Because they've got tens of millions of subscribers.
And
Huge
also
business.
a lot of cash with no debt. They're throwing off a lot of free cash. They're coming out with their own iPad in about another month or so, and we think they'll probably get a lot of traction on that. And so RIM has gone from being a growth stock at $150 to a value stock at a little over $50.
It's going to be amazing to see how that one pans out. We're going to be right back with Lorne Steinberg. He's answering your questions on value stocks and high-yield bonds. The number to call, 1-855-326-6266, or there's the email address. We'll be right back.
Markets worldwide.
Here's an email from Jerry. The subject, Rogers. Is it a good time to buy Rogers for a long-term hold?
I'd have to say it's probably not a bad time to buy Rogers because the stock has been depressed. Rogers has very good exposure to the wireless space and cable, which are both still doing relatively well. What they're facing with is what the whole industry is facing, which is increased competition and probably declining margins. That being said, Rogers should be able to increase its dividend. They're throwing off a ton of free cash flow. They're buying back a lot of shares, and they're in perfectly fine financial shape and very well positioned for the wireless revolution that continues. For us, Rogers is just a little bit too expensive because we really like to buy things when they're super cheap, and for us, that price is $30.
$30. Where's Rogers right now?
Trading in the mid-30s.
Right, so another $5 needs to come off before you're there. We have a caller on the line from Montreal. Go ahead, Patrick.
Yes, good afternoon, gentlemen.
Hi.
I was thinking of setting up some sort of a trust fund for my one-year-old grandchild. And I was thinking of, putting in about $50 a month. And is this type of investment available if you, in buying like one share of a bank stock and adding to it on a monthly basis? And how would I go about getting it started? Thanks for your reply.
Thanks.
First of all, let me say you've got a very lucky grandchild,
Yeah.
and it sounds like a great grandfather. I think it's a great way to get also a grandchild over time interested in investing and saving money. Possibly instead of just buying one bank stock, and in case it turns out to be the wrong investment, you'd probably be much better served buying a market mutual fund.
An index fund.
Like an index fund to get it going where your risk is really well diversified and you're not going to run the risk of having that one bank stock end up being Citigroup and showing your grandchild a 90% loss. But I think it's just a great idea and it's a great thing to do.
Maybe just start a mutual fund account and put the money into an index fund?
Absolutely. Cheapest thing to do, best thing to do for that kind of money.
We have Stephen on the line from Toronto. Go ahead, Stephen.
And I was wondering, again, you touched on bank stocks. I wonder, I was thinking of Bank of Montreal, and they haven't done much the last few years, and they certainly haven't gone back to their 2007 highs. And I was wondering what you think of the Bank of Montreal, and generally what do you think of Canadian banks? Can I hang up and listen? Thank you.
Thank you, Stephen.
Thank you very much for the question. Listen, the Canadian banks are all in great shape. They're in the best shape of any banking system in the world, partly because of government regulation has saved them from a lot of problems. The Bank of Montreal, though, in particular, is not in as good shape as some of the other banks because they got themselves into some trouble during the financial crisis. That being said, the dividend is absolutely secure. You'll see dividend increases from all of them. But they've all had such an amazing comeback in the last couple of years that none of them are really cheap. And, you know, banks are somewhat cyclical with the economy. And if you're, as we're looking for the Canadian economy to probably slow down a little bit from here, loan losses will probably rise. We expect all the banks to suffer a little bit over the next couple of years and think we'll have a better buying opportunity.
We have another caller from Montreal. Eric is on the line. Go ahead, Eric.
The opportunity. My question is a general question about the value of the pharmaceutical company in the States. And I've been going through reports saying that they are very deep discounted. Do you have one name that pops on your screen? If not, what do you think about Pfizer?
Thanks.
Well, one of our top picks, we'll get to that later on.
It's a drug company.
It's a drug company. But on Pfizer, listen, the whole drug sector is all suffering from the same thing. Everybody's got more stuff coming off patent than they have new drugs coming out of the pipeline. And the fact of the matter is they've all been spending tons of R&D money and not getting a very good return for it. Pfizer is in exactly that situation. They were finally forced to make a huge acquisition of Wyeth Pharmaceuticals. But Pfizer had to cut its dividend by 50% a year or two ago. And they're trying to rebuild themselves, and success is not at all clear. So that sector's in tough shape.
There's speculation that they might even try to divest some operations now.
Sure, they've made so many acquisitions in the last few years. Some have worked better, some have worked, but they're trying to get their costs down and get rid of non-core assets and take the money and redeploy it. They're all cutting down R&D facilities, firing a whole bunch of people, and trying to get their cost structure in line with a business which is not growing the way it used to.
We have Kareem on the line from Belleville, Ontario. Go ahead, Kareem.
Oh, hi there. I just wanted to know something about Suncor. If oil is at around about $105, if the oil was to go down, do you think Suncor would sort of go dip down, or would this be a buying opportunity at the current moment, and how far do you think it will go up?
Thanks, Kareem.
Thanks for the question. I mean, all commodity companies like Suncor are going to very much move with the price of the commodity. Oil's had a huge move. Suncor's had a huge move. There's no question in my mind that if oil prices retrace their steps somewhat, you're going to see Suncor fall with the rest of the industry. And again, to buy an oil stock after oil's hit these kind of levels,
$105.
You're probably late to the table, and better off waiting and hoping that there's a retrenchment.
An email from Mirai in Montreal, the subject CGI Group. What do you think about this name?
CGI is a Montreal success story, actually. And they're in the outsourcing business. So they're in a great niche where they go to companies and they say, you're spending $20 million a year on your IT. We'll do it for you for $17 million. You'll save $3 million. And who doesn't want to save money? Every CEO does these days. They've got two huge competitors in IBM and Hewlett-Packard. But they've done a great job. They've built up a great niches in government businesses in the States. Again, the thing is, when you look at the chart on the screen, CGI's doubled in the last 2 or 3 years, and is trading at, on a price earnings and every other valuation, basically the highest valuation since the dot-com days. So for us, there's nothing much left in the stock.
Coming up, we'll get to Lorne Steinberg's top picks, and he's pretty cautious. You don't want to miss this. We'll be right back after the break.